Good morning and welcome to the first Monday call of 2024, brought to you by NZ Funds. I'm Stefan Clark, Chief Client Officer. Many commentators are predicting share market returns to be flat this year, pointing to potential risks such as the United States election and growing tensions in the Middle East. At NZ Funds, we believe the data supports a more optimistic outlook and that many of the negative headlines are a classic sign of skepticism, often seen at this point in the cycle. To use the famous quote from Sir John Templeton, bull markets are born in pessimism, grow in skepticism, mature in optimism, and die in euphoria. This morning, we're joined by Mark Brooks, Principal and Portfolio Manager at the firm, to discuss why NZ Funds believes the global economy has mostly healed from the disruption of COVID, what the United States election may mean for investment markets, and our outlook for gold and crypto, among other important topics. Mark, it's fantastic to have you here.
Morning.
Welcome. Let's start with the role of investment management firms. And we often sort of touch on this in passing, but remind us, why do firms like NZ Funds exist, and how does it fit into the broader financial market?
Exactly. It's a great question, and too often one which we kind of skip, or our industry skips, and go straight into talking about investments and returns, etc. Or the outlook. But if we step back, ultimately, at its simplest, what we're trying to do is the default for pretty much everybody is cash. And cash is useful in the very short term, but over the long term, it's not a consistent way to create wealth. You need to take some risk. And, if we look back through history, New Zealanders have historically taken risk in the property market. And, that is an asset that will do typically around sort of 8%, something like that, 7 to 8%. And if you hold that over very long periods of time, it has the potential, if you're owning an asset that it generates 8%, that's going to double broadly every 10 years. So the important part there is that gives you the ability to take $100 today, turn it into $200 in 10 years' time, and then turn it into $400 in 20 years' time, etc. Now, our role as fund managers is essentially to pull people out of cash and will encourage people to move out of that stable asset cash and to take some risk if their horizon is long enough. And ultimately, property for New Zealanders has been a good choice, but there are other options. And financial markets are a much more liquid option that gives an ability to generate actually better returns than property ultimately shares have over time. And the key is encouraging people to move out of cash to grab, to access assets that have an ability to compound over time and ultimately take that $100 into $200 into $400. That is ultimately our role.
A laudable goal, but and it's an important one, right? Because for people to prepare for retirement, which most savers are doing, and also for people in retirement wanting to think about and secure their future, having reduced perhaps their working, making sure that you're actually generating returns on your assets appropriate with your risk profile and risk capacity and time horizon and all of that is very important.
Exactly.
You can't sustain the living standards that you otherwise would want and could potentially have. So thank you. That's a really good opening to why we do the way, I guess, as an industry, and our firm as part of that industry, what we do. And so let's talk about the global economy over the last year particularly, and where we think it's going, and our outlook and the outlook into the future at this point in time is very important. Decisions get made on it, and so take us through how the NZ Funds investment team are looking at what's happened and importantly where we're going now.
Yeah, and I think I might even go a touch further back. Yeah, the last 3 years, 4 years has really been all about COVID. And I think that's the right way to frame it. In terms of the global economy had this massive sudden stop in terms of COVID. And that was in 20. 2020. And as we went through 20 and 21, the response from governments and central banks was correctly this massive amount of stimulus to make sure the global economy, the stop was only temporary. And from our point of view, what was really interesting in that process was you sat here in late 2020 in New Zealand. We'd had an initial lockdown. The borders were closed, so people weren't coming and going, but life was pretty much back to normal. We didn't have COVID in the community. And it really sort of said to us that, people are resilient. They get back to life very quickly. And, all this, the super low interest rates and the stimulus in terms of government spending was probably going to overdo things in terms of inflation. We didn't realize we probably didn't anticipate how high that was going to be. But essentially that meant you had this massive burst of stimulus come to 2022 and even bits of 23. Really, you had sort of post-sugar blues is probably a good way to put it, where that stimulus impact wore off, and really valuations, as we've talked so much, reset materially, be it interest rates much higher, so that reset bond valuations, share markets fell pretty significantly in different places, property markets fell. So really anything, mainly because interest rates were heading so much high, everything reset in value. The nice thing now is I think our view is very much that that healing process, the post-sugar blues, the hangover, for want of a better word, has passed. And the economy is working through that as healing and is actually looking in pretty good shape in terms of that reset that's happened. And if we look at, I suppose the two primary points we'd sort of point to is one, things like supply chains. Really, supply chains have materially improved. There are still issues in things like the Red Sea in terms of what's happening in the Middle East, but supply chains to and from the US, here from China, etc., you can get those goods much quicker and much cheaper than what you did almost back to, and in some cases better than back to pre-COVID. So that's a real positive. And then the other one is inflation, which I'm sure you'll have a question or two on.
Yeah, I mean, obviously inflation rears its head in sort of different ways, and we experience it with goods that we purchase more routinely, obviously food and petrol and so forth. But it is declining, and it is normalizing. And there's now talk of central banks expecting inflation to be within their target bands in the short to medium term. How do you see the process from here in terms of inflation normalization, and then what does that mean for interest rates, and then in turn for how the economy works and how asset prices respond?
As often, you will hear us talk. We are very focused on the US economy. It's the world's largest economy. It does, and certainly in terms of interest rates, it does tend to lead where the rest of the world moves. And if we look at inflation there, it has been it's come down a lot. It's in some respects, the speed at which it's come down has been quite surprising. And if we go back to sort of the early days of inflation back in sort of 2021, there was a lot of discussion that inflation was transitory. It was going to be a very temporary event, and it would come down whilst it was going up quickly, it would come down quickly. Now, that didn't prove to be the case. Inflation moved much higher than many expected, and it stuck around for a while. But it is looking like it's really, as a classic sort of economist point, the issue of transitory, that was just a time frame discussion. Maybe it is transitory, and we are seeing declines pretty significantly. And if we're sort of focusing on the US, in terms of some of their core measures, their headline number is sort of 3.7%, so well down from the 9s they saw at a peak. But some of their core numbers, which central banks like to look at because it takes out things like the volatile numbers like sort of oil and things of that nature, the last 6 months have been running somewhere even below their 2% target. So that really suggests they've got scope from an interest rate perspective. They've had their foot hard on the brake. They've got an ability to lift that off just because basically the inflation has got very close or towards their targets. In New Zealand, a little bit different. Inflation is proving to be slower. Certainly on the goods side, what they call the tradables here, so anything that has competition from offshore, that is falling very fast. In the last quarter, it was actually negative in terms of the inflation, so we had a little bit of deflation in offshore traded goods. The domestic stuff, the non-tradables, as they call them, are proving to be more sticky. Rents are an issue. They're running at about 4.5% and quite stable. But again, we've seen, and much of that possibly is a reflection of a large immigration into New Zealand, which is driving demand. But equally, I think as some of that rolls through, there is real potential in New Zealand that as we go sort of towards the middle half of the year, that even some of that non-tradable inflation will surprise on the downside and actually, again, puts the Reserve Bank in a situation where rather than talking tough like they are now at the moment, they might actually change their tune and start, by the middle of the year, start cutting rates.
And I guess that leads through into mortgage prices and leads through into mortgage costs and leads through into affordability and it leads through into how other goods are priced too.
Exactly.
Okay, so at the end of last year, towards the end, we had a Monday call where we talked about how, I guess it's fair to say, how wrong economists got it in terms of the global growth expectations for 2023. And then at the end of the year, we looked back and said, wow, I think what did we land in at? Global growth at 2.6, I think was the number. How do you see that today? Has anything changed over the last few months? And where does the outlook forward, with rates coming down, that should be supportive? So, how do you think about, the broader growth prospect? And obviously within that, there's a whole bunch of big things happening, like US elections, there's some geopolitical tensions, there's, China facing some really big challenges. Take us through that.
Yeah, there's a lot there. I might go back a little bit. You sort of touched on last year and expectations. Basically, at the beginning of last year, the expectation, certainly in terms of the commentators, was that global recession was almost a given. As you point out, it turned out that actually growth remained remarkably robust. And the nice thing was that actually, it depends on different markets in different ways, but generally from a global share market perspective, actually returns were pretty positive. Generally markets enjoyed a very strong last quarter. And it did mean that, things like the KiwiSaver growth portfolio, which had a difficult start to the year, finished the year up close to 13%. So that's a pretty good year and really reflects that, one, underlying economic growth in the world was much better than expected. And actually, as we've talked, inflation's coming down. So you did see those signals from central banks start to say, well, actually, we can take our foot off the brake. So there was that optimism. I think, again, our starting point for this year is very much that, as you pointed out in your intro, the Sir John Templeton quote, we do see this as the start of a more positive bull market style cycle. We still think the world is pretty skeptical about that, and actually, in many respects, that's good. In terms of expectations out there, interesting enough, expectations for, and these are sort of market return expectations. The average expectation on the S&P 500 is for it to go up 1% this year. Not particularly aggressive, and Europe's not very different. Again, sort of 1.1, 1.3%. The high expectations are still not actually that high, sort of up sort of 6 or 7%. And there's a bit of a tail on the other side. The most bearish commentators are expecting moves of sort of minus 15, minus 16. So in that sense, there is still that skepticism out there. If we look at things like expectation of recession, broadly expectations are about 50% in the US. So they're still pretty high. Against that, we think there are some really interesting reasons to be much more positive, or to say that, that expectation of recession or very average outcomes is in price now, and we think there's actually a potential that things might surprise on the positive side.
Okay, and so obviously those expectations there of share market growth or share market returns. So in real terms, they're even more negative, right? Because you've got to back out your inflation component. So that's not a particularly, if you believe that, not a particularly compelling investment case as it stands today. But there's a whole bunch of other things supporting it. So take us through what are the factors that are driving you to this perspective that is different from what I guess some of the naysayers or people thinking having an alternative view. What is it that you sort of believe support that position?
Well, I think the first two are clearly, as we talked about. One, inflation is coming down.
Yep.
That is a positive, and certainly the wheels of global trade have freed up. So, from that point of view, a lot of the restrictions out there that were, interest rates were weighing, or the concern of much higher interest rates were weighing on activity and expectations. And the reality of global activity and supply chain pressures have dissipated. There are still issues in the Red Sea, etc., but broadly, out of the dominant production being China, that's gone. So we see that as being positive. Two, we talked about that sort of valuation reset. Valuations have reset, and again from a lay New Zealand perspective, I sort of come back to the property market. We saw massive increases in property prices in 2020 and 21, came back in late 21, 22, and in some cases quite materially. And valuations have reset at levels which maybe aren't super cheap, but certainly seem much more balanced and appropriate. And we see that in the share market. There are parts of share markets around the world that are not cheap. Magnificent Seven, which we might get onto a bit later. Some of those massive tech stocks in the US are not cheap, but they're delivering the returns at the moment. Once you go away from that, in many areas, share markets are very much at long-term average valuations, or indeed actually quite cheap. So that says the starting point for us is actually there's not a lot of positivity priced in, or not an undue amount. Then you go to interest rates and anything sensitive to interest rates, and again, interest rates have come down a little from the highs we saw sort of September, October, but broadly they're the highest level in 20 years. And from that point of view, you're getting your starting point of being the highest level in 20 years is really encouraging. So I think from those two aspects, valuation and certainly the starting point, we're positive. There are some other interesting ones, which I think the key one, which might surprise many people, is actually we see this year is the year of elections, and that is going to create a lot of angst and a lot of noise. But actually, we see that as being a positive catalyst, especially in the US. And as I said, where the US goes, markets tend to follow.
So when you say it's positive elections, what does that mean for investment markets? And how often is it positive?
Yeah.
Because, it's probably a thing of degrees.
Exactly. I think the key part of our process across really all aspects is very much trying to look back and understand what is the context we're talking about. And in the case of, say, a company, we will go back through time and say, well, what margins has this business been able to reliably or historically earn? Has it had 5% margins in the bad times, and it has hit 20% margins in the good times? What is it doing today? Equally, what are people willing to pay for that business in terms of the multiple? Are they willing to pay 10 times multiple in the bad times and 20 times in the good times? So that gives us a box to say, this is the context where we are now, and how do our expectations differ? It's a bit of a long intro to say, in the same way, if we look at the performance of US markets, and very much this is work undertaken by our external manager, Fisher Investments, out of California. And they have spent a lot of time looking at the performance of US election years and share market performance. And the interesting thing about, or the nice thing, I suppose, about the US election and political system is it is a 4-year system. There's no ability for, well, there's really no ability for an early election like there is in ours, our process, and those election dates are effectively baked in stone. And they looked all the way back to 1925, where they sort of had reliable data, and 83% of the time, elections are actually positive. 83% of the time, share markets are positive in election years. So, that's clearly you get years. There are years like with a large external outside forces. 2008 was an election year in the US. Even 2000 was an election year. So there's sort of decent negative years there. But if you think about it, and especially, it's quite topical now in New Zealand, a new government tends to be focused on action and look to make most of their significant promises and policies, bring them through in that very early days. And we're seeing that now in some of the actions of the new government here. In the US, as governments get towards the end of the term, they've done a lot of that and they've become more focused basically on getting re-elected. And more so in the US, we have a midterm structure where often the president will lose control of the House, so really has much less ability to bring in new legislation. So, broadly, so you can summarise that by saying that markets kind of like inactivity on the part of governments, and often they're quite, as the research has shown, 83% of the time they are actually positive in those years, despite there being a bit of noise. Well, some interesting research we've done is if you look at New Zealand and you actually look at those US election years, we've got a very high correlation to the US market performance. Probably not a great surprise, but again, if you're expecting the US market to be positive this year, it actually suggests New Zealand will be. Going back to 1972, every time the US market has been positive in an election year, we have been as well, except for 1 year, which was 1998. That year, the US was up about 16%. We were down 20 basis points. So for us, there's going to be plenty of noise around elections, and there's lots of elections this year. Somewhere, I think, around north of 50% of the world's population is going through some form of election. So that says to us there is going to be noise and there's going to be concern, but often actually at the outcome, once that settles, you end up with a positive year.
Yeah. And in the end, what really matters is whether corporates are generating strong returns and profits, right? And policy settings can be helpful over a longer run. I mean, we've talked in the past about how elections vary in the very short term, don't seem to have a huge amount of effect, but over medium term, clearly they do. And as policy settings change and new agendas get rolled out, but it is that corporate piece, right? For investors, are they generating strong profits? Is there growth in the system? Is there innovation? Their productivity improvements.
And I think at a very short horizon, we are seeing that. Definitely seen corporate earnings coming through. Interesting enough, Meta, Facebook had great numbers the other day. Seemed to have jettisoned the Meta world and gone back to being an advertising business, and that's really working because the economic activity has been more robust and it's coming through in corporate earnings.
There are a couple of we'll talk about Magnificent Seven, which includes Meta, but shortly. But there are a couple of really strong data points out of the US, which I believe are providing us with confidence and others too. Non-residential construction is up meaningfully, and employment numbers were extremely strong. Take us through why they are so important.
Look, I think basically it just says there's breadth of activity in the economy. Certainly, one of the driving forces, both in the US and here, has been government activity, and government activity has been strong and continues to be so. In terms of non-residential construction in the US, that's been growing at around about 20% per annum. They, like us, have an infrastructure deficit that they're looking to work through. And that's creating activity. It's creating that sort of baseline growth, and to a degree, you are seeing it coming through in job growth. They had actually kind of a blowout number on Friday. The expectation for sort of monthly job growth was about 185,000 people. It came in at 350,000 people. Probably at the margin does question whether there's risks of maybe the economy is running a bit too hot from the central bank's point of view, that some of their inflation, their relaxed stance towards inflation might be tested. But it says again, you've got an economy that is, after 500 basis points of interest rate rises, you're not seeing weakening in the labour market there. So, certainly from a share market perspective, that is quite positive at this point in time. That says there's probably a degree of growth that's coming down the pipe, which people are not expecting.
Cool. So let's talk numbers for a second. Share markets. You mentioned earlier that at the end of the 2023 year was a positive for share markets, and that translated into returns for growth investors, including within the NZ Funds KiwiSaver scheme. How has more broadly the share market performed, and tell us about the valuation, that how you think about valuation in the US and why it's normalised, and what that means for investors and the returns there they can expect.
Yeah, and I think first point there, and it's definitely something people need to be cognizant of, is actually returns last year, whilst positive, were really there was a large range. At one hand you had the New Zealand share market that basically was up 2%. On the other hand, you had the S&P 500 that was up sort of 20+%, and then you had some of the tech names that were up 50 or more. So you had a very disparate performance, generally positive. Well, actually, then you go to sort of China and the Asian number of the Asian markets, and they were quite heavily negative. We'll sort of get onto that in a second. But it does mean that actually, if we look through many of those different markets, you've probably got to start with Magnificent Seven. That drove a lot of the US return last year. And those names, I won't go through all seven, but you can very much sort of expect who it is. It's the Apples, the Microsofts, Nvidia, the chip maker who make computer graphics cards, then Meta, etc. Those names definitely saw growth, and they were rewarded for that. The other 493 had a much more muted time, and that's really been that theme. And I suppose, at its simplest, if you probably want to try and boil it down, in an environment of higher interest rates, an old world business tends to be, old world's probably too strong, a more traditional, that's the word I was looking for. Traditional business has assets that require, their capital, require more capital than a technology company that can produce another piece of software at sort of an instant's notice with no spending. So they require capital, and they ultimately will look to have some funding and debt for that. So as interest rates increase, that becomes more challenging for them. Equally, those more traditional businesses, and I think New Zealand's a very good example of that. If you go to a Spark or a Contact Energy or something like that in New Zealand, big household names, very much their top line growth is actually quite dependent on what the economy is doing. What is revenue? Their revenue growth follows GDP growth. If you're a Microsoft or something like that, you tend to generate your own growth. So in an environment where global growth has been slow, that has weighed much more on those names. And you've seen that in terms of sort of performance of New Zealand, to a lesser degree Australia. Certainly small cap names in the US have performed very similar to New Zealand, basically flat over the last year. And Europe is quite similar to that. So there's been quite disparate performance. In an environment of more solid economic growth and interest rates coming down, we think, one of which, probably too early, but one of the stories for this year is going to be that switch away from the dominance. Doesn't necessarily mean to say they're going to do poorly, but away from the dominance of those very big technology names, back to a broader group of more traditional type businesses as the economy grows.
And that's I guess, a function of the relative valuation and the relative return profile between, if you call them value or traditional assets and growth assets, and there being a shift of capital from one to the other. Microsoft just took up the mantle of being the largest company in the world off Apple, which is an interesting shift, and I guess is another sign that they found new avenues for growth in an environment where continuing strength and growth is a positive. Which I think, is a sign that people are willing to pay for that strength of a business model, and in Microsoft's case, that incredible breadth of the innovation that it has and so forth. As Apple does too, of course, but just obviously the market views it slightly differently. Other markets, so developing markets like Japan, which is a developed market, but Japan's had a very interesting year, and other developing markets and emerging markets have had a more challenging year. Talk through where that's coming from and what's driving Japan's, I guess, resurgence.
Yeah, I think it's interesting how, again, disparate the views are. Japan is very much the market du jour today. It has been a market which went back for so many years. It basically, again, because you had an economy which did have deflation for many years, and GDP growth was anemic at best. However, really over the last 10 years, and this has been a 10-year process, and it's probably got another 10 years to go, the Japanese have made a very concerted effort to increase the focus, or ensure that the shift of corporate Japan and listed companies shifted from internally for the benefit of the business or the employees towards making sure the business was working for stakeholders, the owners. So they've made a number of changes over many years in terms of around their cross shareholdings, around their board, having independent members on the board and majority independent members on the board, and various other aspects like that, all which are slow moving, but have definitely moved the management of those businesses closer towards what we'd call sort of a Western style profit optimization focus. One of the ones more recently, which I think is really quite aggressive, actually is probably the right word, is the Tokyo Stock Exchange has brought in a new rule: is if a company has an inquiry or an offer to be purchased by another business, if that offer is above the current share price, effectively they have to open the books to that potential bidder. In New Zealand, for example, generally would go to the board and they would sort of make a view as to yes, no, we think this is worthy, we should open up, or no, we don't think it's worthy. In Japan, the board effectively no longer has that choice. If it's more than the current share price, they need to do that. And that ultimately you would expect will actually encourage more and more M&A activity in that area, and that's positive for that market. So, very much, global investors continue to pick up on that theme, and Japanese shares have done particularly well of late. At the other extreme, the Chinese share market is basically hated by offshore investors. Again, the core of that is probably for strong reasons, that definitely their property companies are going through, for want of a better word, their own GFC type process where housing has a long road to go. And the economy is, by their standards, quite slow. So there are plenty of issues there, and the share market has been down, in the case of the Chinese share market, sort of 3 years in a row, slightly more extreme. If you look at Hong Kong, that's now down 4 years in a row. And, for us, valuation alone is not sufficient. Just because a valuation market is expensive doesn't mean it can't go up further, and the other way around. But what is interesting, again, sort of using those historic analogies and looking back through time, in the case of Hong Kong, It's very rare for a major share market. In fact, even some minor share markets, it's very rare for markets to have more than 4 years down. In fact, even 4 years down is very rare. You can go to markets that have had basically wars or major economic implosions that are longer than that. But it's actually, it's really hard to find a market that's been down 5 years in a row. So in that sense, very much markets are about, they're about, or the question we try to ask is, what is in the price? And, go back a couple of years, late 2022, and to be frank, we kind of didn't see this properly in terms of how negative the market had got on US shares, but clearly, that was in the price because, despite the economy still being pretty weak, shares went up because they'd already priced in all that weakness. If we look at something like China or Hong Kong, it does say to us that actually, potentially all of that negativity is now in the price, and actually it might be quite well. Valuations are super low. Market is very negative about it. That might be a good reason for that to have quite a positive return. So if I'd sort of say anything, probably the outlier this year is actually, at the end of this year, generally people might be surprised how well the Chinese share market does, or how well the Hong Kong share market does. At this point, we're not underweight those markets. We're flat to our benchmark. Still think it's probably a bit early to be in there in size, but it's something we're watching pretty closely.
With Japan, it's fascinating how corporate governance changes can lead to so much more confidence, and that translates to obviously more capital flowing in and buoying asset prices. And I mean, if you think about it, if you're a Norwegian pension fund or something and you're wanting to invest in Japan, and you're looking at the companies there and you're realizing that actually it's really hard to make that investment given the corporate governance risks that apply. If those are lifted, then suddenly the business franchises that you're buying, there's a lot of really incredible businesses within that economy.
Well, again, I think to sort of take that point, because the economy's had basically 30 years since late 1980s where it's gone backwards, you've got a lot of M&A activity that just has not happened. So some sectors, where globally you might have 3 or 4 or 5 players, they might have 20 players, and there's a natural process where M&A should reduce that over time.
Maybe that will lead to the Chinese government revisiting how it looks at these things a little bit in support of foreign capital. Okay, so let's just touch on bonds and bond investors. Obviously, in order to grow your capital through time, you need to be invested in the share market or other growth type assets. But depending on your age and stage and other factors, income producing assets like bonds and obviously term deposits and cash play an important role in diversifying your portfolio and generating a steady income. So bond investors have had a difficult couple of years as interest rates went up, and that's obviously hit the capital value of the bonds. And it's probably fair to say bond investors generally aren't used to negative returns in bond portfolios, which they tend to be less volatile than shares. Now, though, with rates higher and the outlook for them to decline it through time, that's a more positive environment for bond investors. How do you think about that?
I think you've kind of summed it up. Ultimately, in terms of as you go through the economic cycle, the point where you really want to own bonds is where interest rates are high and that interest rate rising cycle has come to an end. If we go back a year, generally interest rates were relatively high, but we still had a period where they were moving higher. And that, the way that works is that creates a capital loss. So you have your 1 year of income from your coupon, say 4%. And if you have a 5% capital loss because interest rates have moved higher, you're back to -1. Think about it this year, though, if you're starting at 4 or 5% and the expectation is a capital gain, that's going to be 4 or 5% plus a positive number. So, generally in these environments, in the case of sort of New Zealand's last two major interest rate declines, 2007 and 2014, in both cases in that sort of over a 2-year period, in those examples, bonds delivered somewhere closer to sort of 20%, 15-20%, more sort of equity-like numbers. And really that's a reflection because you have that original yield and essentially you've locked in 5% and then the competing best available option is 3.5%. So you have an asset that's worth more at that point. And I think that sort of also highlights, we don't necessarily know that's going to be the case this time, but interest rates have gone up very fast. If you look back through time, it's actually surprising how quickly interest rates have come down in terms of the OCR and things like that. So, history doesn't necessarily repeat, but it does often rhyme. So there is a potential actually that whilst again the Reserve Bank is saying interest rates won't come down for a long time, that actually it happens much faster than people think, and especially if you're in cash at that point, waiting for better investment periods, that cash is going to start paying you less. One, and again, it's a little bit of a odd comment, but one comment that I did hear over the summer break is that people sort of, when markets are uncertain, people go to cash until markets settle down. The reality is that instead of markets settling down, they actually often settle up. So that is the challenge there, is that if once people are willing to move out of cash, markets generally, be it bonds or shares, are often higher than they were when they started. But generally, our outlook for most asset classes is pretty positive.
And with a strong economy supporting businesses too, default risk and some of the other risks that bond investors tend to face are lower than, and I suspect that's being seen in how the credit spreads are set up at the moment. But I mean, as rates come down though too, we've got, if you're an investor looking for income assets, you're going to have to get used to having lower returns. On the other hand, once if you sell your bond or it matures, then you're going to be reinvesting at whatever it is, 3.5% now, not 6%. So there's a capital gain there on the one hand, but then you're facing another challenge too.
Yep.
Which is, I guess, why fund managers like NZ Funds exists, finding good opportunities for bond investors and active management that supports that. Okay, so we've covered a lot of things. Last two quick things. Commodities have had a difficult run over the last wee while, and in some areas, and I guess in some have gone up, but they play an important part in NZ Funds' portfolio. We believe that a small, in the growth component, a small allocation to commodities can act as a genuine diversifier and generate additional returns through time. How are you? What commodity holdings are we currently including in our growth portfolio? And then I might lump unfairly, but I'll lump within it. But as the idea of genuine diversifier, digital assets and Bitcoin, where are they sitting within our portfolio, and how do you view the outlook through 2024?
Yeah. Interesting you lump it together, because that is kind of the way we think of it. And we do see sort of crypto assets and especially Bitcoin, the key ones, Bitcoin and Ethereum, as being sort of commodity-like instruments, and increasingly sort of, certainly in Bitcoin's case, gold-like. Generally, our exposures at this point are focused on that sort of precious metal space, gold and Bitcoin, less so in the industrial metals or things like that. As an interesting side, we don't have any positions at the moment, but again, one thing that has been really interesting with negativity around China being so high is that actually, the Chinese share markets had a very difficult time, but actually some of their key imports, industrial imports and commodity imports being iron ore and copper, have actually remained remarkably robust. Copper, 50% of the world's copper demand comes out of China. So if the Chinese economy was really struggling, it would be odd that copper's price is remaining robust. So that's an area we're doing a fair bit of work on is for the year ahead. In terms of the precious metal side, again, I suppose at its simplest, our view is that that is something typically which can be quite challenged by higher interest rates. Think of gold and to a degree, even Bitcoin. It has no inherent yield. If you buy gold now, it doesn't generate a dividend, doesn't pay a coupon. Just sits there. If interest rates are 1%, you don't care. There's no real opportunity cost. If interest rates are 5% or more, there's a real opportunity cost to doing that. So there is pressure on that. And that would have said to us, actually, if we look back through time, generally there's quite a tight relationship between the gold price and interest rates, or to be more specific, real interest rates, so interest rates after subtracting inflation. It's quite a close relationship or inverse relationship there. Interestingly, that broke down quite significantly in early 2022, really as the war in Ukraine started. And what happened there is, if you remember, central bank reserves, are generally held in different currencies and some gold. The Western nations, or particularly the US, froze a lot of Russian reserves that were in their accounts. That really, what that did is it did force or did encourage, I think it's probably the right word, a number of the central banks around the world to up their level of gold purchases for their country's reserves. And broadly, about 3,000 tons of gold are produced every year. Ultimately, central bank purchases went from sort of 500 tons to 1,000 tons. So you now have a situation where they are basically taking a third of all gold produced. That never really hits the market now. So that demand supply dynamic is positive for gold, we think. There's just not as much of it around. Two, also interest rates are high. And now that additional demand has sort of worked its way through the system and is now sort of understood, that relationship with interest rates is reasserting itself. So if we do have a positive view that interest rates are likely to fall, that should be positive for the gold price. In a similar way, if we go back to the heady days of 2020, 2021, when Bitcoin went to sort of 70,000 and had a massive run up and then came down aggressively, really that was highly correlated with risk assets. So basically, technology stocks, NASDAQ, if they went up, Bitcoin went up. One of the core tenets of Bitcoin is that it is fixed supply. It is like gold in that sense. There is a fixed number of Bitcoins out there. So from that demand supply perspective, it should have theoretically a similar, should show similar dynamics to gold. Didn't in that 2020-21 period. From about sort of, the middle of 22, late 22, it did start to display a much closer relationship with gold. Didn't follow up share markets when they initially rose. And that sort of says to us, maybe some of the froth has come out of that space, and actually some interesting long-term dynamics are there. The other one for us in that space is, again, coming back to that demand-supply discussion. Recently, you've seen 11 spot Bitcoin ETFs approved in the US, so essentially ETFs that will buy Bitcoin itself rather than, say, futures or something like that. And importantly, whilst there are 11, basically two big ones. One run by BlackRock, which is iShares, and another one run by Fidelity. And what that does mean is that for a US investor, and especially a number of sort of, it will basically, for a US retail investor or small institutional investor, they can essentially now Bitcoin as easy as they do any other share in America. And they're set up to do that. And we'd expect, one of the aspects that we find interesting about commodities generally is that relative to other, the big investment markets of shares and bonds, commodity markets are very small. So when the broader markets become interested in commodities, definitely that's demand that's felt. And we would expect that as you go forward, it may take some time, but the demand from small investors and medium-sized, small institutions in the US, even if they're just putting 1% or 2% of their portfolio into to Bitcoin, that's a big number. So we would expect there is that really interesting demand-supply balance that's coming through in both crypto and gold over the coming year.
It's a new wedge of demand, if you think about it, which didn't previously exist. And I guess it's time will tell the size of that demand, but there's a lot of money in 401ks and other private portfolios, which now can access Bitcoin, and I guess in a way that it couldn't before. So
it's easy, it's cheap, etc.
Very good. All right, Mark. Thank you very much. There's lots of good stuff in here. I'm excited about this year and watching it all play out, and obviously doing our part for our clients. Any closing thoughts that you want to share on the direction of things? Otherwise, we'll wrap it up.
I think, again, probably just to summarize, we do think we've been through a process where the global economy is healing, even the domestic economy is healing. That will still take some time, but markets are forward-looking and they tend to price in good news in the future now. So we think ultimately it will be a positive year. Coming back to the elections, they are ultimately positive, but they are going to create some noise. So at the same time, I think, it is not unlikely that we sit here at some point of the year and share markets globally might be down 10%. That's not an unusual outcome. We just think it's about being there for that journey, and as that journey gets towards the end of the year, I think it'll be a good one for markets.
And I guess investors, us included, we all need to remember we have long time horizons. So 10% this way or that way over a 10, 15, 20-year period is not that significant, really, is it?
Exactly.
Fantastic. Have a great week, everyone, and look forward to speaking with you soon.
Thanks.
This has been the Monday Call, brought to you by NZ Funds. New Zealand Funds Management Limited is the issuer of the NZ Funds KiwiSaver scheme, the NZ Funds Managed Superannuation Service, the NZ Funds Advised Portfolio Service, the NZ Funds Wealth Builder, and NZ Funds Income Generator. A product disclosure statement for each is available at nzfunds.co.nz. Past performance is not necessarily an indicator of future returns.